Treasury bonds have flipped red here this morning, but stocks are still higher, riding the wave from last week's optimism on earnings, but mostly a story from the Wall Street Journal by Nick Timiraos that the Fed is starting to think about maybe slowing down its course. Let's bring in Jim Bianco, president at Bianco Research. Jim, great to have you here today.
Thanks for having me.
Okay, so what do you think? Are we going to fall for the same narrative falsehood for like the fourth or fifth time this year? Or is this time the real deal? Are we going to hear a different tone from the Fed?
Well, you're right. I mean, we went from transitory to pause to pivot, and now the new lexicon word is stepping down from 75 basis points, which is a virtual certainty in November, potentially 50 basis points in December. So this is also getting legs because, as you pointed out, it was written by Nick Timiraos in the Wall Street Journal, the Fed whisperer. So if anybody else wrote this, it probably wouldn't gotten any attention like it did because Timiraos wrote it. The reason it's getting legs, I believe, is because this is what the market has always wanted. It has had a hard time understanding where this inflation is coming from, why it's going to be persistent, and why the Fed has been so aggressive. It thinks this inflation is a one-time event because of the reopening of the economy that will dissipate and go away. So you don't need to be raising 75 basis points at every meeting. So you're feeding the beast is what you're doing. Now, will it disappoint again? I'll point out that the Fed is in its blackout period. There will be no Fed speeches this week and until next Wednesday's presser. The next person to talk will be Jay Powell a week from Wednesday. He will tell us whether or not this is going to be the case. Is 50 or 75 that important? It's more about the signaling than anything else. I heard you earlier say Fed can't raise rates forever. We all knew that, but it's being taken as a signal that the Fed may be thinking that they've overdone it and that they're very close to ending. And then if they've overdone it, the next thing we could start talking about is when they stop, and then we could talk about when they're going to cut. So it's more about the signaling than the actual action itself.
Boy, Jim, what type of reputational risk do they run in changing their tone meaningfully when it seems like they haven't accomplished anything in the data other than crushing the stock market? Inflation's still going up. We've got employment data beating expectations. Like, if they change their tone now, then, I mean, are there any real mandates?
Yeah, I completely agree with you. And that's why I have a hard time believing that this is going to be the case. Core inflation just made a new year-over-year high in September. So, yeah, there's evidence that inflation's slowing down, not by the official statistic. The economy, after two negative quarters, is going to report third quarter GDP this week. It's going to be positive, maybe positive 2.5% or so. And now they're going to slow down. You're right. I think that is going to be a problem if they try to do that, to explain what it is that's causing them to slow down. Or worse, the market might interpret it as that old, chestnut. What does the Fed know that we don't know? That there must be some kind of deep financial problem somewhere to get them to kind of downshift. So I think if they are going to do this step down, there better be a really good and credible explanation for why they're going to do it now that we've got a new high in inflation and now that the economy is rebounding and that we're still printing 300,000 jobs. When they raised rates hundreds of basis points through a much weaker economy earlier this year without any wavering as to what they were going to do.
It's such an interesting situation that our economy actually has strengthened somewhat by some of the data. What do you make of that, Jim? Is there a potential here that some of the kind of real deterioration and the figures are potentially past? I mean, did we get through a hurdle? The yield curve hasn't gotten any flatter since like June.
Yeah, I think as far as the economy goes, remember that when we talk about a recession, we're talking about real. And what that means is after inflation. So to use the second quarter as an example, the economy grew at 7.8%. That is a very strong number. But inflation was 8.7. So you had real growth of minus 0.9, meaning you grew less than the inflation rate. So a lot of what we're seeing in the economic strength is nominal growth. Inflation is embedded into it. Now it's possible that nominal growth might start to exceed the inflation rate. Look, this is never, the whole story of 22 has never been about problems with the economy other than, well, a big one in inflation. It's been about the financial markets. It's been about the dive in the bond market and about the dive in the stock market and the stresses that that's been putting on investors and companies and portfolio strategy. And that's really where the focus has been so far this year. So if the Fed believes they need a slower economy in order to bring down inflation, they're not really getting it so far, which is why this is such a curious idea that we're going to yet another iteration of this. The Fed must back off. We're going from pivot to step down.
What do you think, Jim? Is it potential, as the potential for a real pause tweaked high enough to change anything for investors or traders? Does it warrant any, let's say if you've been short bonds, short stocks, do you need to hedge a little bit just for the potential of some surprise here? Or do you think that generally we should stick with the trends that have been in place?
Well, at least for this week, it'll probably continue to work because there will, like I said, there's a Fed blackout. There will be no communication. Yeah. There will be no communication to suggest one way or another what they're going to do after the November meeting. We'll just have to wait for Chairman Powell's speech a week from Wednesday. And then when we go into that speech, that will essentially be the question that we'll want to know. What are you going to do at the next meeting? Are you still thinking the same about inflation, or are you thinking something else? Remember, the Fed Fund Futures is suggesting that the terminal rate, that's where the Fed's going to stop, is around 4.75 to 5%. If the Fed hikes 75 basis points at the December meeting, they'll be at 4.5 to 4.75. So they'll almost be there. The whole idea the market thought was the Fed was going to front load this stuff. They were going to get to that terminal rate as fast as they can and then pause. But going 50 suggests that they're going to slow this down. For what reason? That they're worried about something. That's what really the concern is. So yeah, I think that this week investors should be prepared that if the market shows some hopium on this idea that we're going to get a step down, there's going to be no pushback on that, at least this week. It will come next week at the press conference.
Hey, Jim, do you think that in the meantime, kind of a side discussion, but the last few weeks we've also been balancing some of these black swan style potential since the bond market in the UK really was on fire? We had a discussion a couple weeks back about these concerns that there was going to be real systemic shock. There might have been some concern by some that a big bank, Credit Suisse, was going to blow up, that we were going to have a whole different kind of set of problems stemming from that location. Are we moving past that? Did we sweep it under the rug? Should we still be potentially worried that something like that could happen here? What do you think we learned?
Yeah, first of all, let's remember now that the bond market is too big, too opaque, and too complicated for anybody to know where the next problem is going to be. So no one knew that, looking at the surveying the situation in the bond market in late September, that the British liability-driven investing scheme was a pension scheme was going to be the next thing to cause us a problem. But that said, when you look at the record losses in the bond market, if you look at the MOVE index, the Merrill Option Volatility Index, the VIX of the bond market, it's at one of its highest readings ever right now. If you look at measures of liquidity in the bond market, they are terrible. They're back to great financial crisis of 2008, 2009 type levels. And you put all that together, it is very reasonable to assume that there are a lot of people in the fixed income market that are in a bad place. Are they in such a bad place that they're about ready to go over the side? Well, that remains to be seen. But it is a reasonable thing to think that there is problems in the bond market that haven't quite bubbled up yet. Now, maybe we skirt those problems. Maybe we do see a peak in yields and we see a decent bond rally to take the heat off of them like we did in June, or maybe not. But I do think it is reasonable to say there is a lot of pain in this bond market right now. And that the question is, how much more can it take, to use the old phrase, before more dead bodies start to float to the surface? But do not think that there's no problems out there right now, given the losses and the volatility and the terrible liquidity.
Okay, great stuff. Jim, thanks for the thoughts. Nice way to start the week for us, getting all the big subjects on our mind with the calendar on the Fed, too. Very helpful for us. Thanks, Jim.
Thank you.
You got it. Jim Bianco, president at Bianco Research. Not quite buying the pause, step down. We'll see what Powell says next week.